Hey everyone, welcome back to Corporate Decoder. Today, the Advisors Inner Circle Fund just filed their amended N-CSR report for the year ending the 31st of October 2025, and I am seeing a key correction that investors need to know about. Quick note, this is not financial advice, just my take on public filings for educational purposes. This amended filing is primarily a correction on auditor fees, but it reveals how important accuracy is in these reports. So, what we have here is an amended filing, meaning they're correcting something from a previous report. The initial filing was on the 9th of January 2026, but they found a mistake. The paperwork explains that after they filed the original report, they discovered some incorrect numbers related to fees paid to their auditor, PricewaterhouseCoopers, or PwC, for the fiscal year that ended on the 31st of October 2025. This filing is specifically to fix those fee amounts. They're also very clear that the numbers for the prior year, 2024, were correct and haven't changed. No other changes are in this update. This tells us that when companies report financial details, even small errors can mean you need to refile and be very precise. The company, the Advisors Inner Circle Fund, manages several different investment funds. This particular report is about the LSV Global Managed Volatility Fund. They offer this fund in both institutional class shares, which often have lower fees, and higher investment minimums, and investor class shares, which are more accessible to individual investors. Now, they give us a look at the fund's performance and costs for a hypothetical $10,000 investment in the institutional class shares. The costs for the last year were around $81, which is 0.75% of that investment. For the investor class shares, which have slightly higher costs, that same $10,000 investment would have incurred about $107 in costs, or 1.00%. This difference in percentages from 0.75 to 1.00% might not seem huge, but over time, especially with larger sums of money, those fees can really add up. It's smart for investors to understand how these expense ratios affect their long-term returns. Looking at how the fund did, the global stock market, measured by the MSCI AQUE World Index, actually went up by a strong 22.64% for the 12 months ending the 31st of October, 2025. The US stock market did even better, with the S&P 500 climbing 21.45%. The report notes that big US tech companies really drove this growth. Value stocks, which are typically seen as underpriced, honestly lagged behind growth stocks. And for a fund called the Managed Volatility Fund, it is interesting that lower volatility stocks also underperformed, returning only 7.82%. Given this backdrop, the LSV Global Managed Volatility Fund, institutional class shares, managed to grow by 15.00%. The report mentions that the fund's tendency to invest in cheaper stocks, or value bias, and its focus on lower volatility actually detracted from its performance compared to the broader market during this specific period. The investor class shares saw a similar 14.74% gain. The report emphasizes that both stock selection and sector allocation played a role in the fund's performance relative to its benchmark, with a noticeable impact from not owning some of the big tech names that soared. This table shows a 10-year history of how a $100,000 investment would have grown. Let's look at the most recent 10-year period for the LSV Global Managed Volatility Fund institutional class shares. That $100,000 investment would have grown to about $220,090 by October 2025. Now compare that to the MSCI AQUE World Index, which is a benchmark for global stocks. A $100,000 investment in that benchmark would have grown to a much larger $292,080. This highlights that over this specific 10-year span, the fund underperformed its benchmark, a key point for long-term investors to consider. Looking at the average annual returns, the institutional class shares returned 15.00% for 1 year, 13.17% over 5 years, and 8.21% over 10 years. The MSCI AQUE Index, on the other hand, returned 22.64% for 1 year, 14.61% for 5 years, and 11.31% for 10 years. This consistent underperformance against the benchmark over longer periods is definitely something to note. Let's peek at some key statistics for the fund. Total net assets were about $10.24 million. The fund held 144 different investments. Notably, the total advisory fees paid is listed as a dash, meaning zero for this reporting period. This is likely due to the fee waiver mentioned later. The portfolio turnover rate was 22%, meaning they bought and sold about a fifth of the fund's holdings during the year. Geographically, the fund leans heavily towards the United States, with 55.4% of its assets invested there. Japan follows with 7.6%, and the United Kingdom with 4.3%. The rest is spread across other countries. The top 10 holdings give us a snapshot of where the fund's money is concentrated. Cisco Systems is the largest holding at 2.3%, followed by Johnson & Johnson at 2.2%. Bank of New York Mellon, Cognizant Technology Solutions, and Bristol Myers Squibb also appear in the top 10. These are all pretty well known, established companies. The schedule of investments paints a detailed picture. In US common stocks, we see familiar names like Alphabet and AT&T in communication services, Altria Group and Kroger in consumer staples, and Bank of New York Mellon in financials. In the healthcare sector, we see Bristol Myers Squibb, CVS Health, and Johnson & Johnson again. For information technology, Cisco Systems and Cognizant Technology Solutions are listed. The fund also has a significant allocation to foreign common stocks, making up 42.6% of its investments. This includes holdings in companies like Unica Insurance Group in Austria, Aegis in Belgium, and Petrokina in China. Japan is a notable area for foreign investments, with companies like Honda Motor and Japan Post Holdings. The fund has invested a substantial amount in Japanese companies, totaling 7.6% of its assets. This includes diverse sectors like consumer discretionary with Honda Motor, financials with Japan Post Holdings and its insurance arm, and healthcare with Alfresa Holdings. Even with geopolitical concerns, the fund has exposure to China, with 2.9% of its assets there, primarily in financials like Bank of China and energy with Petrokina. The United Kingdom represents 4.3% of the fund's investments, with holdings in sectors like consumer staples, including British American Tobacco and Tesco, and financials with HSBC Holdings. Unfortunately, there is no mention of Germany in the provided document. France accounts for 3.0% of the fund's assets. This includes communication services with Orange, consumer discretionary with Michelin, and energy with Total Energies. Italy holds 1.1% of the fund's assets, spread across consumer discretionary with Pirelli and C, and energy with Eni. Spain makes up 2.5%, with investments in energy sector with Repsol, industrials with Logista Integral, and information technology with Indra Systemas. Sweden represents 1.5% of the fund's portfolio, with investments in consumer discretionary like Autoliv and financials with Swedbank. Switzerland holds 2.0% of the fund's assets, with a significant portion in healthcare with Novartis. The report indicates no allocation to Russia for the fiscal year ended the 31st of October 2025. Looking at the statement of assets and liabilities, total assets are just over $10.25 million. The vast majority of this is in investments, which are valued at about $10.08 million. Liabilities are quite small, only about $18,000. This means the net assets of the fund are right around $10.24 million. For the institutional class shares, the net asset value per S-share was $11.62, and for the investor class shares, it was $11.71 per S-share. It is typical for different share classes of the same fund to have slightly different net asset values due to different expense structures and share counts. The statement of operations tells us how the fund made and spent its money. Investment income, mostly from dividends, was about $388,000. After all expenses, including investment advisory fees, administration, and other operational costs, the net investment income was $296,000. The fund also saw a net realized gain of $714,000 on investments, and a net change in unrealized appreciation of about $351,000. All in all, the net increase in the fund's net assets from its operations for the year was a healthy $1.36 million. One important detail here is the waiver of investment advisory fees for the year. $58,000 of the advisory fees were waived. This means the investment advisor is choosing to absorb some of the costs for the shareholders, which is usually done to keep the fund's overall expense ratio within certain limits. As we saw earlier, the statements of changes in net assets show how the fund's size evolved throughout the year. The net increase in net assets from operations was $1.36 million in 2025. However, distributions paid out to shareholders were a significant $1.28 million. Then, looking at capital share transactions, there was a net increase of $453,000 from institutional class shares and a net decrease of $20,000 from investor class shares. Combining all these, the total increase in net assets for the year was $511,000, bringing the total net assets to $10.24 million at the end of the year. This shows that while the fund generated gains, a good chunk of that was returned to investors, and new investments and redemptions also influenced the total asset size. The financial highlights table provides per share data for each year. For the institutional class shares in 2025, the net asset value at the start of the year was $11.73, and it ended the year at $11.62. The total return for the year was 15.00%, which aligns with what we saw earlier. However, It is interesting to compare the ratio of expenses to average net assets for 2025. It was 0.75%, and that is with waivers. Without those waivers, it would have been 1.75%. This reinforces how the waiver significantly impacts the reported expense ratio. For the investor class shares, the expense ratio without waivers was 2.00%. Again, this highlights the substantial benefit of the fee waiver for shareholders, effectively lowering their costs by a full percentage point in this case. Now, let's dive into the notes to the financial statements, which always contain crucial details. The fund is organized as a Massachusetts business trust and is part of the advisor's Inner Circle Fund, which has 27 different funds. This particular report is just for the LSV Global Managed Volatility Fund. For valuing securities, they use market prices when available. If market prices aren't readily available, they use fair value procedures. They've also designated the advisor as the valuation designee to figure out fair values for these hard-to-price assets following CEF rules. As of the 31st of October 2025, there were no securities that seemed to require this fair value approach, meaning everything was valued based on available market prices or other clear inputs. The schedule of investments gives us a lot of detail on what the fund owns. It shows a breakdown of holdings by country and by sector. For example, under US common stock, we see allocations to communication services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, and utilities. The US market makes up 55.4% of the fund's investments. Foreign common stock makes up a substantial 42.6% of the fund. This includes holdings across Europe, Asia, and other regions. For example, they have investments in Austria, Belgium, Brazil, Canada, China, Denmark, France, Hong Kong, Hungary, Italy, Japan, Malaysia, Netherlands, Norway, Portugal, Singapore, South Korea, Spain, Sweden, Switzerland, Taiwan, Thailand, and the United Kingdom. It is a truly global portfolio. The total value of investments in the fund is $10,077,000, which is 98.4% of the fund's net assets. The cost of these investments was $8,779,000. This difference between cost and market value gives us an idea of the unrealized gains in the portfolio. There is also a small holding 0.4% in a repurchase agreement valued at $36,000. The report from their independent auditors, which is Ernst & Young LLP as indicated in item 4, states that they've audited the financial statements and that in their opinion the statements present fairly, in all material respects, the financial position of the fund. This is a standard auditor's opinion, confirming the financial accuracy as of the 31st of October 2025. Now, let's circle back to the specific item that caused this amended filing, auditor fees. For the fiscal year ending the 31st of October 2025, PricewaterhouseCoopers LLP or PwC billed the trust $96,175 for audit fees. This is for the audit of the trust's financial statements and services related to regulatory filings. Interestingly, under tax fees, the report shows $682,400 for services to service affiliates that did not require pre-approval. This is a substantial amount. And it is important that companies are transparent about what services are rendered and how they are approved. The report also breaks down fees for Ernst & Young or E&Y. They billed $587,404 for audit fees for the fiscal year ending the 31st of October 2025. Cohen & Company also billed for audit fees around $45,800 for the same period. This section details aggregate non-audit fees for PwC. The non-audit fees billed to the registrant and its investment advisor were $682,400 in 2025. This is a significant figure, and it gets a lot of attention because it can raise questions about auditor independence. The report states that all these services were pre-approved by the Audit Committee. The Audit Committee has a policy for pre-approving services. They have to review any services proposed by the independent auditor. They determine if the services need specific approval or if they fall under a general approval. If specific approval is needed, the Audit Committee considers if the services are consistent with CC rules and if they would impair the auditor's independence. The committee also delegates some pre-approval authority to its chair or financial expert for services under $100,000, which is a practical measure. So, what is the takeaway here? This amended filing is a good reminder that even in complex financial reporting, accuracy is paramount. The core of this filing is about correcting auditor fees, specifically a large non-audit fee related to tax services for affiliates that was $682,400 for 2025. The sheer amount demands attention. The fund itself, the LSV Global Managed Volatility Fund, has shown steady but slightly underperforming growth compared to its global benchmark over the last decade, and its value and low volatility focus didn't shine in the recent bull market. The key risk I am watching is how the fund's strategy performs in different market conditions, especially considering the persistent gap against its benchmark. What I am actually looking for is a clearer explanation of how those large non-audit fees at the affiliate level align with maintaining auditor independence, even with pre-approval. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Discord is in the description.